Which retirement income should you take from first? Should you pull from your 401ks or your TSP accounts? Should you start your Social Security benefits right away? Should you maybe start taking from your IRAs, your Roth IRAs, or your brokerage account? What I can tell you, it absolutely matters what order of operations that you start taking your retirement income from in your retirement, because the wrong decision could actually cost you thousands of dollars. And in today's financial freedom video, we're going to walk you through smart withdrawal strategies with simple examples. And we're going to let you know what order of operations that you should be pulling from when it comes to your retirement income. So definitely stay locked in. Hi, my name is Carson Graves, Certified Financial Planner and President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
Now, before we jump into our lesson today, there are always two rules to retirement income that we like to give you. And Andrea, what are those two rules?
Well, rule number 1 is to never run out of money, and rule number 2 is to never forget rule number 1. And by the way, if you want to go deeper into these kinds of retirement topics, Carson covers them step by step in his first published book, How to Retire with Confidence: 5 of the most common pitfalls that could derail your retirement. You can get it today on Amazon by clicking in the link in the description below. So now let's dive into our topic today.
Now, when it comes to which retirement account you should be tapping first in retirement, if you have a 401k or if you have an old TSP account, or if you have any other qualified retirement accounts like an IRA, maybe you have a Roth IRA or a brokerage account, and you also qualify for Social Security, there is an order of operations that you should try to follow when it comes to which particular retirement account you want to take from first. Because each of your retirement income sources may be taxed differently. And so if you go in the wrong order, it can absolutely mean more taxes. It can mean a smaller Social Security check, and it can mean less money for you over time. So let's just take a look at this example for Mark, who's age 62. And let's just say Mark needs $70,000 a year for living expenses, and he has these accounts at his discretion. He has a traditional IRA or 401k with $600,000 in it. He also has a brokerage account with $200,000, and he has a Roth IRA that has $100,000 in it. He does not have a pension, but what Mark is planning to do is delay his Social Security to age 70, which will increase his Social Security monthly benefit from $1,900 per month at age 62 to $3,200 per month at age 70. So let's go ahead and evaluate what Mark is going to be doing between age 62 and age 70. So we're going to look at these years as the bridge years in which he needs $70,000 a year. So let's take a look at the first scenario here. Let's just say that Mark is going to tap into his traditional IRA first and foremost between these years, and he's going to be taking $55,000 per year out of his IRA. And by doing this early on, it's going to help him to reduce his future required minimum distributions from that account at his required minimum distribution age. Also, because he's reducing his IRA and reducing those RMDs, it's also going to reduce the risk of him having IRMA surcharges on his Medicare Part B and Part D premiums. The next account that he will tap into would be his brokerage account, in which he would take approximately $15,000 a year from, and he's going to be using long-term capital gains or qualified dividends from this account. And the good thing about using long-term capital gains to supplement your income is that long-term capital gains can be taxed at 0%, but no higher than 20%, which is typically lower than what your ordinary income taxes would be. So that's going to get him the $70,000 per year that he's needing for income. And by doing this, it's also going to allow Mark to avoid tapping into his Roth IRA, and he can leave that account to grow tax-free or maybe to be left as an inheritance for his estate. So now let's go ahead and fast forward, and Mark is now at age 70. As we mentioned, he needs $70,000 a year. But at age 70, he's now going to be collecting $3,200 per month from Social Security, approximately $38,400 per year. This is going to allow Mark to now reduce his IRA withdrawals to $16,600 per year, and he can still continue to take from his brokerage account of about $15,000 per year. Again, at this time frame, because he's been taking money out of his IRA, that's going to mean smaller RMDs in the future and also lower taxes as well. And he can also continue deferring that Roth IRA for a later date, which is going to be able to grow tax-free. So why does this strategy matter? Well, I'm about to show you why this is so important because it can be very, very powerful when it comes to taxes. So Mark, who's a single tax filer, when he looks at taking money out of his IRA, the $55,000 is taxed at his ordinary income tax bracket, and Mark will pay approximately $6,839 in taxes on those dollars. Mark will also pay capital gains tax of 15% on the $15,000 that he's taken out, which will be about $2,250. His total taxable income after his standard deduction will be approximately $54,250. So his total federal income tax liability here is a little over $9,000. But at age 70, let's take a look at what happens to Mark's income. Mark is now taking $16,600 from the IRA and paying ordinary income taxes of $2,650. The tax on the $15,000 on the capital gains is now going to be taxed at a 0% tax rate because he's not going over the threshold for capital gains to be taxed at 15%. Mark is also only going to be taxed on one half of his Social Security benefits of $38,400. So his total taxable income at 70 and beyond is $35,050 after his standard deduction, and his total federal income tax at this point is now $3,964. That is a significant difference in taxes at this point. That is why a strategy like this would absolutely matter throughout your retirement years if you're able to understand the order of operations of which accounts you should be pulling from, because it'll give you a more tax efficient retirement long term. So ultimately, why does this strategy matter? One, Mark will be able to stay in the 12% ordinary income tax bracket at age 70. This strategy also is going to preserve tax efficiency for Mark and reduces his future RMDs related to taxes when Social Security kicks in at age 70. And because he's taken from his IRA sooner rather than later, any tax increases will be minimized at this point. So the moral of this video is that the order you take money in retirement isn't just a tax decision. It's also a longevity strategy as well. And it's important that you do get the sequence right because it can help your money work harder and also allow your taxes to stay lower. And we would like to hear from you. Let us know what income you may turn on first and why in your retirement years in the comment section below. Again, thank you for watching, and make sure that you do always speak to a certified financial planner in your area to help you with these types of important decisions.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.